Hello investors, welcome to Business Learnings. In this video, I'll be talking about three fundamental parameters which which probably do not get enough attention, but which are very important if you want to analyze a company. And I'll be using Screener.in. Just a disclaimer: I'm in no way associated with it. I just use it. It's part of my habit. And there are a lot of different websites also where you can search for your stock and do analysis. Now, go to screener.in and search for the company you want to analyze. I'll be talking about Avenue Supermarts. I'm already on this page, so I don't need to click on that. The first parameter that I want to talk about is the debt to equity ratio. And in very basic layman terms, it simply means how much leveraged the company is, how much debt the company has in very basic terms. So the debt to equity ratio is 0.03 for this company. Typically what happens is the more debt you have, if you borrow money from banks, debt means borrowing. If you borrow money from banks, you have to pay them back. You have to pay them interests, quarterly interests. And the problem is, even if you do not generate any income, you still have to pay those EMIs, those interest payouts. You still have to do it, and that's why a high debt company is not preferred. And that's why we always want to look out for companies which have very low debt to equity ratio. DMart has just 0.03, which is a great number. I would say virtually debt-free company, a very little debt, no burden of interest payment at all, very little burden. And that is what makes you flexible. If you do not have such burden, you know, in COVID-like situation where a lot of companies suffered only because their operations were shut down and they didn't have any source of income, and they still had regular cash outflows thanks to their highly leveraged positions, high amount of borrowings that they had. So debt to equity is a very important parameter. You should always look out for companies which have this number as low as possible. If a company has more than one of debt to equity, you should be worried. You should be worried. Now, this parameter is highly correlated to the industry that you want to you are researching in. For example, for in airlines industry, in manufacturing industries, the kind of industries where you have to buy a lot of machines, a lot of equipments, you have to buy lands and set up your factories there. So you will have to take debt. You will have to borrow a lot of money, and that's why it's understood that those kinds of capital intensive machinery intensive companies, they tend to have a little higher debt to equity ratio, but that's understandable. But typically this number should be as low as possible. So this one was our first parameter, debt to equity ratio. Our next parameter is return on capital employed, and sadly a lot of people they do not give it its due credit. It's a very important parameter. It tells you how much return your company is generating on the invested capital. I'll give you an example. Let's say you decide to start a business with 1 lakh rupees. You put in 1 lakh rupees of your own money, then you borrow 1 lakh rupees from the bank, so you have put in 2 lakh rupees of capital. Next year you do some sales, you produce stuff, you do some sales, you pay off salaries, you pay off for raw materials, and the amount that you are left with is 50,000. You end up making 50,000. Know that you still have to pay you took a loan of 1 lakh rupees, you still have to pay some interest on it, and you have not paid it. You are left with 50,000 rupees. You will pay off your interest, you will pay off your taxes from it, but that's a different thing. You are left with 50,000 rupees. 50,000 rupees, and your invested capital was 2 lakh rupees, so 25% will be your return on capital employed. So this was as simple as I could explain it to you. And as a rule of thumb, you should be looking forward to a return of capital employed of at least 15%. and there should be a consistency. There are industries, for example, automobile industry, metal industries. They are cyclical in nature. When I say cyclical, it means that there are years when the economy itself is down, and these sectors suffer a lot. And in those cases, especially in those companies, you will see that return on capital employed, it's very low. Probably sometimes it could even be negative. Uh, but it's your call whether you want to invest in such companies or not. But as a general rule of thumb, you should ensure that you get at least 15% of return on capital employed every year. For DMAT, we see that in March 2013, it had 15% for 2014-21, grade 24, 24, 26, 20. So a decent number, comfortably above 15%. So it means that it's generating 20% on the invested capital. Fixed deposits generate what, 5-6% every year, and it is generating 15-20%. That's good enough for me. It's a good company. So yes, ROCE, return on capital employed, or return on invested capital, same thing, is a very important number. Now, third important parameter, which is not part of fundamental analysis, but you should be looking into that number, is the FIIs and DIIs holding. See, if you scroll down on screener, you will see shareholding pattern, and therein you will see the stakes of promoters, FIIs, DIIs, and public. Promoters are the owners of the company. FIIs are foreign institutional investors, all the foreign money that comes into India, that uh, foreign institutional investors, mutual funds, portfolio investors, and their money into India, is all of it comes in FII. DIIs are our own institutional investors, domestic mutual funds, or other financial institutions like LIC, or all those things, insurance companies. Uh, and public is what the retail investors hold. Now, when I talk about FII, DII holding or shareholding pattern, you should be looking forward to four things. The promoter stake should not be decreasing. In DMAT's case, it is decreasing, 74.99, and it used to be 82.2% in December 2017. Now it's just 75%. Promoter selling its own stake is seen as a very negative scenario. Promoters are owners of the company, and if they are selling off their stake, it means that they are not confident about the business. Most of the times, this is the case, and that's why it's taken as a negative news. That's why you should be worried if a promoter is selling this stake. But for DMAT, there is no need to worry, because this was probably a regulation by SEBI that companies promoter cannot hold more than 75%. So that's why this is understandable. It doesn't concern us. Next thing is, you should ideally be targeting to those companies whose FII and DII holding is consistently increasing. For DMAT, it is increasing. Okay, it is increasing. For FII's holding is increasing. It was 9.62% in March, and now it is 10.27%. For DIIs, it was 6.56 in March, and it is 6.11% in September. Probably they have done some profit booking. For public, this is a very important parameter. The public holdings, they should not be increasing at an alarming rate. And the reason I'm telling this is because retail investors in most of the cases lose money. If you are seeing a company having higher and higher percentage of public holding through through the quarters, it means that there is something wrong. It means that promoters, FIIs or DIIs, are dumping their shares and retail investors are buying. So you should be very careful about this. We are seeing that the retail holding has actually come down. If you see from or it has come down, or more or less it has remained constant in the last couple of quarters, which means that there is nothing, there is no red flag. So these three parameters, they are not much talked about, not much covered in the fundamental analysis, but these are very important parameters. And if you do a research on any company, shareholding pattern, your debt to equity ratio, or how the company is managing its debt, and how the returns are being generated on the invested capital, these are very important parameters. So I hope this video was informational. If you really liked it, please press the thumbs up icon, subscribe to the channel, and thanks a lot for watching.